Welcome to today's business studies class. My name is Emmanuel Wido. Today's class focuses on the theme, bookkeeping and business success, and the topic, double entry bookkeeping. By the end of today's lesson, you should be able to, number one, state the meaning of double entry bookkeeping, analyze events and transactions using double entry system, identify accounts to be credited and accounts to be debited, match every debit entry with corresponding credit entry, and then lastly, post from journals to ledgers. All transactions in the business world have two effects. It's either a positive effect or a negative effect. For example, if you step into a mart and you desire to buy a bottle of soft drink, let's say you have 200 naira and you are thirsty, so you need a bottle of soft drink. You walk into a shop, a mart, to get one. When you step into there, you're giving the storekeeper your 200 naira, right? And let's say the bottle of soft drink is 100 naira. What happens? The person gives you a bottle of soft drink, but then the person is losing that bottle of soft drink. When you give the person 200 naira, the person gives you a balance of 100 naira. That means you have lost 100 naira. Now, this is the balancing. When the storekeeper gave you a bottle of soft drink, he lost that one bottle of soft drink. So he needs to replace it when he goes to the market. But then he has gained 100 naira from that transaction. On the other hand, you gave the storekeeper 200 naira and a balance of 100 naira was given to you. That means you have lost 100 naira. But then you gained a bottle of soft drink to quench your thirst. That's what happens in business transaction. But before we go, let's look at the quick definition of double entry bookkeeping, which is the topic for today's class. What is double entry bookkeeping? Now, double entry bookkeeping is a system of accounting where transactions are equally recorded in two or more separate accounts. So in this case, let's say there is a debit transaction. That debit transaction occurs in two accounts being run by a business organization. We will get to find out what these two accounts are. But before then, it is important to note that double entry bookkeeping law states that every financial transaction has equal and opposite effects in at least two different accounts. It is used to satisfy the accounting equation which states that assets is equal to liabilities plus equity. Your assets are things that bring value, monetary value to you, the money you gain. Liabilities are basically expenditures, what you lose in a business. The equity can be seen as your profit, your retained earnings. Now, in double entry system, transactions have two aspects. You either have the credit aspect or the debit aspect. Unlike in the banking world, where if you walk into the bank and you want to deposit money, it is termed credit. That's not what occurs here. The reverse is the case when you're looking at double entry bookkeeping. As we proceed, you will find out. Now, in our example, we stated that someone walked into a mart, right? Now, let's pick a name. Okon buys a bottle of Coke, for instance, 100 naira. Now, Okon has to credit his food expenses account with 100 naira and debit his cash account with the same 100 naira. Now, Okon is buying something, right? So he is crediting food he bought. We are assuming that the bottle of Coke is food. So in the account for debit, he is putting a bottle of Coke there. But in his account for credit, he's putting 100 naira he used to pay for the Coke. We will have a table to explain this very clearly. Let's proceed by looking at the two columns we have in double entry bookkeeping. There are basically two, the debit column and the credit column. So what do you find in the debit column? So under the debit column, we have an entry at the left-hand side of the account record. So when you have an account record and you check that it is divided into two, know that your debit records should appear at the left-hand side. Sometimes they do not mark them, but then some accounting books have DR at the left-hand side to indicate that that is your debit column. Now, what else can you find in the debit column? You have an increase in the value of assets. So basically, all your assets, monetary terms, should appear in your debit column. Then you should have a decrease in the amount of liability and equity. So liability and equity shouldn't be necessarily found in the debit column unless it ought to be there. Unless it's a gain, then you can put it there. Then an increase in expenditure or expenses. So if you have an increase in expenditure or expenses, then you can capture it there. Then you should note that the debit column is a receiving account. Money coming into the firm is captured in the debit column. So let's look at the credit column. It is an entry at the right-hand side of an accounting record. So while we have the debit on the left-hand side, the credit is on the right-hand side. Then next we have it that a decrease in the value of assets is recorded in the credit column. Remember that in the debit column we have an increase in the value of assets, but in the credit column we have a decrease in the value of assets. Thirdly, an increase in the amount of liability and equity. So while we have liability and equity decreasing in the debit column, in the credit column, liability and equity are actually increasing. The fourth difference, so to say, is that in the credit column, we have an increase in income and revenue. And then lastly, the credit column is a giving account. So when you're spending money, you should remember to record your expenditure in your credit column because you gave the money out. The money didn't come in. If the money came in, then you need to record it in the debit column. What are the rules that govern the debit and the credit column? There are some golden rules in accounting. For a real account, debit is what comes in, while credit is what goes out. Like I told you before, in the banking system, we believe that when you credit, it means you put money in there, and when you debited your account, it means you took money out. But when you're looking at accounting, debit refers to money coming into an account, while credit refers to money leaving an account. For nominal accounts, debits are expenses and losses, while credit involves incomes and gains. For personal accounts, you debit the receiver and credit the giver. For the use of credit and debit columns in a typical bookkeeping account, the following rules apply. Number one, debit balance increases in amount when a debit, which is at the left column, is added, and reduces when a credit at the right column is added. Now, the type of accounts that obey these rules are expenses accounts, assets accounts, and dividends account. What's the second rule? The second rule states that credit balance increases in amount when a credit, which is the right column, that income is added to the credit, and reduces when a debit, that means all transactions are added to the left-hand side of an account. The types of accounts that obey these rules are liabilities, revenues, equity, and capital. Then the third rule, the total amount of debits must be equal to the total amount of credit in any given transaction. So let's simplify it. Account types: assets, expenses, dividends. What do you record? To record an increase, where do you record it? Debit account. A decrease, where do you record it? Your credit account. For liabilities, revenues, equity, and capital. So these are account types. Now, when you look at an account type, you now look if it is increasing or decreasing. If your liabilities are increasing, you're recording it in the credit side. If your revenue decreases, you record such in your debit side. So when you look at your account and you look at what is happening to that account, is it increasing or decreasing, then you know exactly which entry they should fall under. Now, going further, there are basically two types of accounts when we are looking at double entry bookkeeping. We told you that these are transactions that must be recorded in two or more accounts. So when a transaction occurs, it should be recorded in two separate accounts. The first of them is a journal. So what is a journal? A journal is a record of financial transactions ordered by dates of transaction, which accounts were affected, and the amounts, and they are usually in a double entry bookkeeping method. So when you're looking at double bookkeeping accounting, you should know that a journal is a tool for such. Traditionally, a journal is defined as a book of original entry. So someone buys a bottle of Coke. The first book you should key such a transaction into is the journal. So what do? You credit. When I say credit, it means you're keying the value, the amount the person bought your bottle of Coke. You're keying that value into the debit side of the account book, and then you're deducting the bottle of Coke in monetary figures from the credit side. That means you have a deficit of a bottle of Coke. Now, going further, a journal is a detailed account that records all the financial transactions of a business entity to be used for future reconciling of and transfer to other official bookkeeping records, such as the general ledger. Now, what are the types of journals? There are various types of journals, but for this class, we'll look at a few of them. The first of them, sales journal. The sales journal, also known as the sales book, records all credit sales. Credit sales means what you have sold to people. For the purchase journals, the purchase journal records all acquisitions, purchases made on credit during a period. So when someone comes to buy something and probably the person did not pay, you record such in your purchase journal. If the person paid for it, it means it will be captured in the sales journal. But in a situation where the person did not pay, you record such in the purchase journal. So the purchase journal keeps track of all orders placed using vendor credits or account payables. Now we also have sales returns journal. Now, sales may be returned by a customer. I bought something maybe in excess and I found out that I do not need them as much as I thought. So I could go back to the storekeeper and say, please, I need to return and probably get a refund. So when that happens, we record such in the sales returns journal. Now, in the case of sales return, a credit note is usually sent to the customer stating that his account has been duly credited. So now what happens? Let's assume that the person has an account with the firm and probably you just pay money into the firm, and then when you come in, you make your business transactions. That means you pay on time for those who pay for stationaries. So in a situation where more stationaries were sent to your firm more than what you expected, they could debit or they could retrieve the excess and then credit your account based on the value of the goods being returned. So that's what this is talking about. And a typical example of the sales journal we talked about is this. You could see your date, the accounts debited, the invoice number, and then you also have the accounts receivable, and then you have the cost of goods sold, then you have your total. Then we also have your purchase journal, which also has the supplier's accounts credited, the invoice date, payment terms, are you paying using a check or cash? And then you have your accounts payable, the items, item 1, 2, and 3. There are various forms of this purchase journal. Another type of journal is cash receipt journal. A cash receipt journal is a specialized bookkeeping record, and it is referred to as the main entry book used in accounting system to keep track of sales of items when cash is received. By crediting sales and debiting cash and capturing transactions related to receipts. For cash receipts journals, what we are looking at is that it captures what you have sold, the sold items. It's like your normal receipts. We are giving you a proof of payment. You see the receipts that people issue to you, they are duplicates. So those duplicates are what you use to capture in your ledger. So the cash receipts journal is like a proof. You're giving it to the person who came to buy something that, okay, this is a proof of what you paid for and the items you collected. But then the duplicates also serve a purpose for other accounting purposes. Next, we have the purchase returns journal. For purchase return journal, just like the sales returns journal where the customer returns, in the purchase returns journal, we are looking at a situation where the seller is the one returning goods to the supplier, the person supplying him or her goods. So that's just it for purchase returns journal. The next type of journal we have is cash payment or the disbursement journal. For the cash payment journal, it is a record of all financial expenditures, whether made with checks or cash, that a company records before transferring such transactions to the general ledger. And this type of journal serves the following functions. Number one, a source of recording tax write-offs and the categorization of other expenses. A typical cash disbursement journal is what you have here. Here we have your date, you have the check number if you're using a check, then who are you paying it to, and then the account debited. Then we also have other features such as cash, if there was a credit coming in, inventory, and then other accounts debited, and then accounts payable. So there you have it, a typical cash disbursement journal. Then we have the journal proper or your general journal. The general journal is a day book which is used to record transactions relating to adjustment entries, opening stocks, accounting errors. The source document of this prime entry book are journal vouchers, copy of management reports, and invoices. General journals contain all the transactions from other journals, just for your comprehensive look. Now, going further, the second account we should be looking at when we are looking at a double entry bookkeeping is the ledger. Now, the ledger is known as the second entry book. The journal is your first entry book, while the ledger is your second entry book. It is used for recording and totaling economic transactions. It contains information which is required in preparing any financial statement. Ledgers are measured in terms of monetary units. This is telling us that in the journal account, you could have items. But for ledger, it must be in monetary figures. So we can have 10 cartons of Coke in a ledger, but we could find such in a journal. All components of a ledger are drafted from the journal account. So all the information you need to develop a ledger is gotten from the journal account. That is to say that the journal is the primary source of data for preparing a ledger account. Now, what are the types of ledgers? There are basically three types of ledgers we will consider in this class. And the first of them is the sales ledger. It is a group of all accounts related to customers to whom goods have been sold to on credit. That means the customers did not pay, but goods have been given to them on credit. So you capture that in your sales ledger. Now, the sum of all the money owed to the business by their customers is shown here, and it is termed accounts receivable, trade debtors, or sundry debtors. Now, we also have purchase ledger. For purchase ledger, it records purchases and expenses whether or not they have been paid for. Now, a balance sheet that totals the unpaid bills is usually called trade creditors or accounts payable. So when you make purchases as a business entity and then you do not pay for them, maybe you made them on credit, you are recording such transactions in the purchase ledger. When you also make purchases and you paid for them fully, you also record such in the purchase ledger. Then finally, we have general ledger. You should understand that a typical business involves sales and purchases. Somebody needs to buy, and then when the person has bought, then the person can now sell to other people. So let's assume now you want to start a business. You have to purchase from a supplier. When you purchase from a supplier, a customer has to come in and then you sell to the customer. That's why you basically have purchase. For purchase, we are looking at it that this person is buying from a supplier. Now for sales, we are looking at it that a customer is coming to buy from the person that is selling the goods. Now for general ledger, it is a set of numbered accounts a business uses to keep track of its financial transaction and to prepare financial reports. So the general ledger summarizes the assets the firm has, the liability the firm incurs, equity, revenue, and expenses the firm has made. So we could say that the general ledger is a typical financial statement of a business entity. This is a typical example of a general ledger of a business entity. And for this account, it is captured electricity expenses. So you find out that we have dates, March 15, June 17, September 14, December 31st. So this could be seen as a year general ledger. And then you have all the captured variables in it. That's why I told you that the general ledger could be said to be the financial statement of a business entity at the end of the year. So let's see how we can apply double entry bookkeeping with this example. The following financial transactions were done by Okeke and Sons Limited in the month of January. Represent the financial records using double entry bookkeeping methods. What are the transactions? On the 1st of January, the owner of the business deposited 1,000 naira into the business bank account. On the 3rd of January, the owner of the business paid 275 naira for the purchase of 250 t-shirts. On the 9th of January, the firm made sales of 210 naira. On the 14th of January, the firm paid 150 naira for advertisement. And on the 29th of January, Tola Limited paid 450 naira for goods purchased into the company's account. That means these goods were bought on credit. So let's see how we can capture this in a typical double entry account. All right, class. This session is an explanation on how we can successfully key in the data that was given to us in the course of the lesson. Remember, I gave us different transactions that took place for a particular firm in the month of January. So we will try to categorize those transactions into the debit side of a typical double entry account and also the values that should appear on the credit side. And also remember that double entry means that if we impute it into a general ledger, it also means that the values must also appear in other ledgers such as the cash or capital ledger, the sales ledger, and the purchases ledger. So it means that in as much as you capture everything in the general ledger, you also have to categorize the transactions that took place into their separate and unique accounts. So as we proceed, we'll try to balance a typical account sheet, and then we'll also try to see how we can categorize all the transactions that took place for this particular firm in the month of January. So shall we proceed? Now, we have a typical cash account. And on this cash account, we have the debit side, which is on the left-hand side, as I told you in the class. And we also have the credit side, which is located at the right-hand side. Both debit and credit sections of a typical account sheet have the date, the details of the transaction, the folio number, if any, or folder number, and then you have the amount. As well as on the credit side, you have the same thing, your date, the details of the transactions, folio number, and then the amount. So let's try imputing the values as given. On the 1st of January, the owner of this business deposited 1,000 naira into the business account. Let's assume that that is the startup capital. So since it is money for the business, the money belongs to the business, we capture that under the debit side of the account. So you have it January 1st, bank deposit savings, 1,000 naira. Now on January 3rd, the business paid 275 naira for the purchase of 250 t-shirts. Because money left the firm made expenses. We capture that in the credit side of the account. So you have it 3rd of January, purchase of 250 t-shirts, amount 275 naira. On the 9th of January, the firm made sales to the tune of 210 naira. That's money inflow. It means money came into the account, cash inflow. So you capture that under the debit side of the account. So you have 9th of January, sales made 210 naira. On the 14th of January, the firm paid for advertisement to the tune of 150 naira. That will be captured in the credit side of the account. And finally, on the 29th, a cash deposit from Tola Limited was paid into the company's account, and the amount paid was 450 naira. Because the money was paid to the account of the firm, it means money came into the firm. As such, we record it in the debit side. As you have it, 29th January, cash deposited by Tola Limited for sales, 450 naira. With that, we have keyed in our data of transactions made by this firm into our cash account. But then our next task is to balance this account. If we add the values on the debit section, we will have a total of 1,660 naira. Let's see what we will have if we add that of the credit side. Adding the values on the credit side together, we will have 425 naira. This does not balance. We can see that 1,660 naira is greater than 425 naira, but we have to balance this account. So to balance the account, we have to deduct 425 naira from 1,660 naira. When we do that, we will get a balance carried down of 1,235 naira. This means that the firm still has a balance of 1,235 naira to spend. Now, that amount, 1,235 naira, is recorded as balance carried down, and you record such in the credit side of the account. When you have done that, you can now add both sides and then see if the account is balanced. Having done that, our next task is to see if our account is now balanced. So you will do this with me. You will add the debit section and see if you arrive at the values on the credit side of the account. So adding 1,000 plus 210 naira plus 450 naira, we arrive at 1,660 naira. Now, if we add 275 naira plus 150 naira plus the balance carried down, which is 1,235 naira. If you add that, you'll arrive at 1,660 naira. With that, we have balanced our account because the total on the debit side is equal to the total on the credit side. Now, what happens to the balance carried down? Because it is still money for the firm. It is still money the firm can use to run the business. The balance carried down is brought down to the debit side of the account and recorded as 1,235 naira. What does this mean? This means that at the beginning of a new month, which is February, the firm has a balance of 1,235 naira to begin the running of the business with. So what is left in the firm's account for running the business is 1,235 naira, and that is recorded as balance brought down and then under the debit side of the account because it is money that belongs to the firm. The firm still has the ability to use it. The firm is not spending the money. It's there for the firm to use and run the business. You can call that the asset of the business. Now, remember that I told you that these transactions
must occur twice. So we have successfully recorded them in the cash account. Now we have to break them down because they must be found in two accounts. Looking at our data, we can group these transactions into three, and that is transactions that can appear in the capital account, transactions that can appear in the sales account, and then lastly, transactions that should appear in the purchases account. So which transaction among all of this can we say should belong to this account? Now remember that on the 1st of January, 1,000 naira was deposited into the company's account. So that is what we record in our capital account. It means that that is the capital for starting the business. So you have it 1st of January, capital deposit 1,000 naira. That is the only transaction that can appear in our capital account. Now, what are the transactions that we can capture in the sales account? Looking at our data, we have only two. The sales made to the tune of 210 naira, and then the cash deposited by Tola Limited for sales, which was 450 naira. So you can see that the transactions that can be found in our sales account should be: number one, sales made 210 naira, sales made to Tola Limited 450 naira. And then lastly, what then do we capture under the purchases account? That can only be: number one, the purchase of 250 t-shirts, which was for 275 naira, and then payment for advertisement. That means you purchased rights to advertise, maybe in a newspaper, a magazine, a radio station, a television station. So you purchased something. So those two transactions is what you capture in your purchases account, like I have done here. So we have purchases of 250 t-shirts to the tune of 275 naira, and then payment for advertisement 150 naira. With that, we have categorized these transactions into capital account, sales account, and purchases account. I hope, having seen the processes, you can successfully key in transactions into an account and then balance the account, and also categorize the various transactions into their own unique accounts. That will be all for now. Thank you.
Having done all that, we have come to the end of today's class. But before we go, let's take a quick summary of what we have learned today. We learned that the concept of double entry bookkeeping states that every financial transaction has equal and opposite effects in at least two different accounts. We also learned that debit column is a bookkeeping entry that either increases an asset account or decreases a liability account. Next, we learned that credit column is a bookkeeping entry that either increases the liability or decreases the assets of the business organization. We further learned that one of the key differences between the debit and credit column is that the debit column represents an increase in assets, while the credit column represents an increase in liability. Next, we learned that one debits the receiver and credits the giver when accounting using double entry bookkeeping. Going on, we learned that a journal is an account that records all the financial transactions of a business entity to be used for future reconciliation of and transfer to other official bookkeeping records. Next, we learned that there are 7 different types of journals in bookkeeping. Furthermore, we learned that the purchase journal is a record of all acquisitions paid for or bought on credit during a period. We also learned that general journal is a daybook or journal which is used to record transactions relating to adjustment entries, opening stock, accounting errors, etc. Next, we learned that a ledger is a principal book or computer file for recording and totaling economic transactions measured in terms of monetary units of account. And finally, we learned that there are three main types of ledger, which are the sales, purchase, and the general ledgers. With that, I would like to test to know if you have learnt anything in today's class. Let's attempt 2 questions. Question 1. Dash states that every financial transaction has equal and opposite effects in at least 2 different accounts. Option A, bookkeeping entry. Option B, double entry bookkeeping. Or option C, opposite entry bookkeeping. The right answer to question number 1 is option B, double entry bookkeeping. Question 2. The debit column records an increase in assets and is recorded on the dash side of the double entry bookkeeping. Option A, the right hand. Option B, the left hand. Option C, the upper hand. The right answer to question number 2 is option B, the left hand. This is where we draw the curtain in today's business studies class. I hope by now you understand what double entry bookkeeping talks about, and you can also apply it in financial accounting. Until I see you again in another business studies class. Bye-bye.